Hi, I'm Phil Grande at philsgang.com. The market crash is unfolding. Now, people wouldn't think so because every day the market, new high, new high, new high. But those new highs are fake. They're not real. And I'm going to explain that. And this is how markets collapse. When they keep making new highs, like they're doing, that's the danger signal right there. And that's when everybody starts getting in. When everybody starts getting in, especially retail customers, when the market's making new highs, that's always when it starts collapsing. So let's take a look at what is going on. What's bringing the collapse on? Well, you got to go back to 2008. When you go back to 2008, remember these oligarchs right here, they're the same people that own the Federal Reserve, that control the Federal Reserve, and the same people that control the S&P 500 companies. They're the 1/100th percentile. That's right, just 1/100th percentile of our population. They call the shots. They make it happen. And they don't care about Main Street. In fact, when you take Wall Street, you keep hearing Wall Street, think of Bond Street. Now remember, bonds. A bond simply means that as bonds go up, all these guys, we'll call them instead of Wall Street guys, Bond Street guys. When bonds go up, they're making money. They keep making money as bonds go up. Now, but the problem is when bonds are going up, the interest yields are going down. So interest rates are going down. Now that would be a good thing if these same guys would print money and see the $6 trillion, move it over to the corporation, and the corporation would take that money and do business investment, buy new equipment, new machinery, so that the people would produce more. And when they produce more, instead of producing 100 shares an hour, they produce 2,000 an hour, then that means the value of their value goes up and they should be paid more. But remember what's happened. When the big boys right here, the oligarchs, decided to change us from an industrial community, industrial to finance. So we became a financial economy instead of an industrial economy. Remember, they destroyed the middle class. The middle class was so strong because the middle class, remember, was protected by labor unions. And when the corporations got money, or just take their profits, they would plow their profits right back into the company, and their earnings would go up, production would go up, and people would make a great living, and then they'd go out and spend money. And remember, 72% of our economic growth comes from spending. It was working, but the companies were forced to do it because we had big labor unions, and they couldn't get away with taking that money and doing what we call stock buybacks. But by the time the 70s and the 80s came, that was gone. Unions gone, everybody's gone, nobody's there to protect the labor. And so they decided in 2008 that they're going to take care of themselves and not Main Street. So they print the money, give it to the company, and the company, instead of plowing it into new equipment, new machinery to increase productivity, increase wages, and which increases your standard of living, which increases our economic growth. They said, to hell with that. Here's what we want you to do. We're going to give you the money, the corporations, but we want you to take that money and we want you to keep reducing the number of shares you have. Because once we had that stock market crash, it was very difficult. People didn't have money. They didn't have savings. They lost their homes. It was going to take too long to get the economy going. So they decided, let's just trick everybody. What we'll do is let's take the money and keep reducing the number of shares. So let's just take Cisco. Say Cisco had 3,000 shares. And let's say the stock was at $50. Well, they could get it up to $55, by increasing their earnings from, let's say, 5% to 6%. But what would happen after the crash, they couldn't get their earnings up. So their earnings went from instead of 5 to 6, went to 5 to 4. So the price of stock would go from 50 to 45. So how'd they stop that from happening? Well, they take that printed money and they went in each company and they reduced the number of shares. So the more shares they reduced, then it was easier to spread the lower earnings across a lower number of shares so the stock price would go up. So that's what they kept doing. The money was provided, zero interest rates, and they keep buying their own shares, drop the 3,000 shares to 2,500 shares to 2,000 shares, and that way the stock price would keep going up. So it was fake. It was all fake. And they've been doing that since 2008 right to today. And so what happens is the stock market's going up, and the economy, if you take Main Street, okay, they're in trouble because, again, remember, they're not getting wage increases. Inflation, is chewing them up. Healthcare is chewing them up, their costs. And so all they care about, the Federal Reserve, is to make sure the stock market goes up by funding corporations that keep buying down the amount of shares they have to create this fake stock price. And so remember, the more money they print and give to the CEOs, the more the stock price goes up because they strictly take the shares and reduce the number of shares. They don't have to have profits anymore. Okay, it's called it's prosperity without profits. But they've been doing this for so long now. The problem is they're keeping interest rates at zero. The inflation is going to start taking off, especially now because you got Biden in there. He's going to do all kinds of stimulus. He's going to do tremendous amount of printing of money. And for make sure everybody's got free college, free this, free that. And the more money they are printing and going to print creates more inflation. And that inflation is going to drive prices up. It's going to drive prices of milk, and everything's going to go up. But wages aren't going up because, remember, they're not putting money into companies to help you make more money by getting new equipment and so forth. They're putting money into companies so they keep reducing the number of shares. They fake the stock price to move the stock price up. So the more they're printing money now that Biden has taken over, there's going to be so much printing of money. It's going to be unbelievable the amount of money they're printing. What they used to take 4 years to print $3 trillion. Under Trump, they're printing $3 trillion in 1 month. They'll be printing $3 trillion a day. That creates such inflation. Okay, so the bottom line is this. The market, this is when the markets, are going to start crashing. When you start seeing the stock market making new highs, but they're only making new highs because they're printing money to reduce the number of shares, then it's a matter of time before it collapses. And at the same time, with all this money being printed for all the new programs coming in, that creates inflation. And that inflation, is eating, it's like a tax. And the folks, there's no more middle class, remember. The middle class is gone because once we lost those unions, nobody there to protect them. There's no more middle class. It's the oligarchs, and it's the oligarchs, the 1/100th 1%, it's the 10th percentile. That's it. Everybody else is screwed. So, and one last thing. Remember, they're not there to help you. Wall Street is not there to help you. They want to make sure that the economy isn't doing well. That's why they're not going to put money in here and tell the CEOs to do business investment. Because they want to make sure the economy doesn't do well. And so the more they don't do well, remember, people go buy bonds for security because they're scared. And the more they buy bonds, the more the bond prices go up and Wall Street keeps making more money. So the idea is to make sure the more the economy goes down, the worse the economy gets, the more wealth they create on Wall Street. And also, the worse the economy gets, the more money they print to give to the companies, okay? And also, the more money they print to buy from the government, because they're broke, to buy their debt, put it on their balance sheet, and they give them a credit card in exchange. Also, what they're doing is printing money right now, and they're going to corporations, buying all the corporate debt, putting it on their balance sheet, and giving them a credit card. So we are entering this phase now. It's that one last phase right before the crash, when the inflation is going to go nuts. So once again, remember, nobody cares about you on Main Street. They want the economy to do terrible. So they, in the 10th percentile, will make more and more money. Then eventually when the market crashes, they're going to even make more money because they're going to be selling stocks short. Okay? And that's what we teach our students every day, how to short stocks. That's it. So again, yes, we're getting closer and closer to that day of the crash. And we can tell because, again, I've been on this earth for 74 years. And I've been in this market for over 50 years. I've seen it over and over. As the market tends to seem to be going up and making new and newer highs, that's when you know it's over. And then when you see all the retail customers starting to come in who were never in the market before, now they're coming in, that's another signal the market's ready to collapse. But remember, the stock market's not the economy. The economy is going down, the market is going up. Just give you one last little bit of information. Do you know, how can we have earnings? Think about this. If you take the earnings, or think of profits per share, okay, of a stock. If you take the earnings per share of each stock, they're saying it's up 400%. But if I take the aggregate of all the S&P 500 stocks, put them together, the earnings of all of it is only up 175%. Wait a minute. How can you put all the S&P 500 companies together and have earnings up 175%? But each individual stock is up 400%? What are you, nuts? So the gig is up. We're getting closer. So this is great. I love it. See you on the charts.